Did you know that a major European investor just cut its stake in Bank of America, one of the largest banks in the United States? Moves like this don't happen quietly. They often hint at bigger shifts in the financial world. Today, we're breaking down exactly what happened, why it matters, and what it could mean for BAC stock and the banking sector as a whole. We'll also look at the signals traders and algorithms are watching right now. Stay tuned, because by the end of this video, you'll have a clear picture of whether this is just routine portfolio management or a potential warning sign for the markets. Let's start with the news itself. A new filing shows that Livförsäkringsbolaget Skandia omsättet, better known as Skandia, a Swedish insurance company, recently sold off part of its position in Bank of America Corporation, ticker symbol BAC. Institutional filings like this are required by regulators, which means we get a rare peek into how billion-dollar investors move their money. These aren't small trades. When a firm like Skandia trims its holdings, the market pays attention. Why? Because institutional investors are often seen as the smart money. Their decisions can set the tone for how other investors, big and small, view a stock. And when it's a bank as large and influential as Bank of America, the ripple effects can be even bigger. Before we dive deeper, let's set the stage. Bank of America is the second largest bank in the U.S., right behind JP Morgan Chase. It serves more than 67 million consumer and small business clients, manages trillions of dollars in assets, and plays a massive role in the U.S. and global economy. When something happens to a bank this size, it doesn't just affect shareholders. It affects credit markets, lending activity, and in some cases, even the broader economy. That's why institutional moves in BAC stock can be so important to watch. So, why would Skandia reduce its holdings? There are several possible reasons. First, portfolio rebalancing. Large investors constantly adjust their portfolios. If one stock grows too large in relation to others, they may trim it back, even if they still believe in the company long-term. Second, interest rate sensitivity. Banks like BAC are highly sensitive to the Federal Reserve's interest rate policy. Higher rates usually boost bank profits through lending, but they also increase risks, like loan defaults or slowing demand for credit. Third, sector rotation. Sometimes, investors simply move money from one sector to another. For example, they might take profits in banking and shift into technology, energy, or bonds. And fourth, taking profits. If the stock has had a decent run, trimming shares is one way to lock in gains without exiting completely. So, the move doesn't necessarily mean Skandia has lost faith in Bank of America, but it does raise questions about timing. Why now? Now let's talk about the stock itself. As of the latest data, BAC shares have been trading in a choppy range. Like many bank stocks, they've been under pressure from concerns about the economy, consumer debt levels, and global growth. When an institution reduces its stake, it can sometimes put short-term pressure on the stock price. That's because the sale adds to supply in the market. But here's the interesting part. These filings are often delayed. By the time we find out about them, the sale has already happened. So the market may have already digested it. That's why traders need to look beyond the headline and focus on the chart. Pull up BAC on TradingView or your preferred platform and watch the key levels, recent support, resistance, and moving averages. This is where algorithms come in. Algo traders don't just read headlines. They scan price action, volume, and volatility in real time. A sell-off like this can trigger trend continuation signals if price breaks down through support, or reversal signals if the stock bounces back after the sell-off. Tools like the Super TrendAlgo or Heikin-Ashi indicators can highlight whether the move is just noise or the start of a bigger trend. And remember, institutions may sell gradually, not all at once. So these signals can be useful in spotting whether selling pressure continues over the next few weeks. But let's zoom out. This isn't just about one investor and one stock. It's about the entire banking sector. Banks are under pressure right now. On one hand, higher interest rates help them earn more on loans. On the other, rising defaults, slowing lending, and regulatory scrutiny create headwinds. Consumer debt in the U.S. has hit record highs, and corporate borrowing costs are up too. If the economy slows, banks like BAC could feel the squeeze. Skandia's move may reflect broader caution about financial stocks, not just Bank of America specifically. So, What should traders and investors be watching? BAC earnings reports. Bank of America's quarterly earnings will give direct insight into loan growth, default rates, and profitability. Federal Reserve announcements. Any change in interest rate policy can impact bank margins. Institutional holdings. Keep an eye on whether other large investors are also trimming BAC. If multiple institutions are reducing exposure, that's a stronger signal. Technical indicators. Watch for trend continuation or reversal patterns. Algos often spot these faster than humans. So, here's the bottom line. Yes, Skandia sold part of its stake in Bank of America, but that doesn't automatically mean disaster for BAC. It could be simple rebalancing, or it could reflect caution about the broader banking sector. What matters is how the market reacts next and whether other big investors follow. Now I want to hear from you. Do you think Bank of America is undervalued right now? Or is this a red flag for financial stocks? Drop your thoughts in the comments. And if you found this breakdown helpful, don't forget to like, subscribe, and hit the bell. Here at TrendAlgo Finance, we track the moves, the signals, and the strategies, so you don't miss what's coming next in the markets. Thanks for watching, and I'll see you in the next one.